The most dangerous financial advice you will ever receive comes from the people who love you the most, not because they have bad intentions and not because they want you to fail. It is because they are handing you a map for a terrain that no longer exists. If you follow the standard script today, work hard, get a safe job, save 10%, buy a house, you won't end up wealthy. You will end up trapped. And the reason is simple. The economic physics that allowed your parents to build wealth have fundamentally broken. Two engineers, same salary. One follows the advice from 1990, the other ignores it. 30 years later, the first one is still working, the second one is retired. The difference wasn't how hard they worked, it was the operating system they used. Let's look at the reality, because numbers don't have nostalgia. 30 years ago, the safe path worked. You could buy a median home for 3 times your annual salary. You could put cash in a savings account, and the interest would actually beat inflation. A single income could support a family. The system was designed to reward saving and labor. That system is gone. Today, in most major cities, a home costs 10 to 12 times the average salary. Savings accounts pay you virtually nothing, while real inflation eats your purchasing power alive. We have shifted from a labor-based economy to an asset-based economy, and nobody sent you the memo. This is why you see high-income professionals, doctors, lawyers, engineers, making top 1% incomes but feeling constantly behind. They are playing a 20th century game with 21st century currency. The frustration you feel isn't because you are bad with money, it's because you are applying rules that expired in 2008. But here is where it gets interesting. What used to be risky, like leverage or aggressive asset allocation, has become necessary to maintain your position. And what used to be safe, like hoarding cash in a bank, has become the riskiest thing you can do. We need to dismantle the outdated software running in your brain. Because if you try to win today's financial game with yesterday's rulebook, you lose every single time. Let's define exactly what that rulebook looks like, because most of us are following it subconsciously. It goes like this: go to university, take on debt, get a stable corporate job, buy the most expensive house a bank will approve you for, save 10%, retire at 65. This is the default setting for 99% of the population. And here is the problem. This advice is not just outdated, it is mathematically impossible to execute with the same results your parents had. When your parents gave you this advice, they weren't lying. They were teaching you how to win the game they played. In 1980, the standard path was a winning lottery ticket. University was affordable. Corporate loyalty was reciprocated with pensions. Housing prices were rational. If you followed the rules back then, the system rewarded you with a middle-class life that was actually comfortable. But you are not playing in that economy. You are playing in a hostile environment where the cost of the basics, education, housing, and healthcare has exploded, while wages for even high-skilled labor have stagnated in real terms. When you follow that old script today, you don't get stability. You get a golden cage, you get the high-paying job, but the salary is immediately devoured by the debt you took on to get the job. You buy the house, but instead of an asset, it becomes a liability that traps you in a zip code. You save your 10%, but the purchasing power of that money degrades faster than the interest compounds. This is why we have a generation of high earners who are technically rich on paper but are terrified of losing their paycheck for even a single month. They followed the advice perfectly. They were the good students, and their reward is a life of high-stress subsistence. Now stay with me, because this next part is the key to breaking out. In a world of rampant asset inflation and currency debasement, playing it safe is the most aggressive risk you can take. Standing still is moving backward. The traditional advice convinces you to prioritize protecting your downside, but in doing so, it completely caps your upside and leaves you vulnerable to the silent erosion of your wealth. The safe path assumes that if you are a good employee and a diligent saver, the system will take care of you. That contract has been voided. The system is no longer designed to reward labor, it is designed to reward capital. And as long as you are following a script written for laborers, you will continue to run on a treadmill that is moving faster than you can sprint. So we have to stop looking at our parents' financial habits as a roadmap. We have to look at them as a history lesson. What worked for them is the very thing that is keeping you stuck. To understand why, we have to look at the math. In the 1980s, you could walk into a bank, deposit your paycheck, and receive a guaranteed 10 to 12% return. You didn't need to understand the stock market. You didn't need a side hustle. You just had to be disciplined enough not to spend everything you made. In that world, saving money was a legitimate wealth-building strategy. Your cash was an asset that compounded on its own. Today, with interest rates barely fighting inflation, cash is a melting ice cube. But your parents remember the time when cash was king, so they tell you to hoard it. Then, there is the housing market. This is where the generational disconnect is most violent. When your parents told you that renting is throwing money away, they were doing the math based on their reality. 30 years ago, buying a home was a forced savings plan that made sense. The median home price was roughly 3 times the median annual income. A single school teacher could support a family, buy a home, and pay it off in 15 years. Today, that step has become a wall. In major economic hubs, home prices are now 10, 12, or even 15 times the median income. But here is the deeper structural shift that nobody talks about. The economy your parents worked in was designed to reward labor. The economy you work in is designed to reward capital. In the 20th century, wages grew alongside productivity. Corporate loyalty was a real contract. You gave them 40 years, they gave you a pension. That pension was a guarantee. It meant the risk of your retirement fell on the company, not on you. That world is extinct. The pension has been replaced by the 401k. The risk was quietly transferred from the employer to the employee. Now, if the market crashes the year you retire, that is your problem, not the company's. This explains the disconnect. Your parents look at your 6-figure salary and cannot understand why you feel broke. To them, a high income equals wealth. They don't see that the purchasing power of that income has been hollowed out. They see you spending money on tech gadgets and assume that is why you can't afford a house. They don't realize that you could cut every discretionary expense to zero and still be mathematically unable to afford the down payment they made with a summer job savings. So when they give you this advice, they are handing you the winning lottery numbers from 1990. They are operating on survivor bias. But this brings us to the most uncomfortable truth of all. If the old rules are broken, what are the new ones? If saving is losing and labor doesn't pay, how do you actually win? The answer might surprise you. The system that replaced the old one is not designed for the saver. It is designed for the debtor and the investor. And the fundamental engine of this new system is a phenomenon that most people feel but cannot name: financial repression. To understand this, you have to look at the money itself. When your parents were building their lives, money acted as a store of value. If they put $100 in a vault, it held its value. Today, we live in a regime of negative real rates. This means the interest you earn is lower than the true rate of monetary debasement. When you follow the old advice to save money, you are not storing wealth. You are storing a melting ice cube. You are trying to transport water in a bucket with a hole in the bottom. The harder you work to fill it, by getting raises, working overtime, or side hustling, the faster the purchasing power leaks out. This is the silent thief that makes high earners feel poor. You are running up an escalator that is moving down. In the 1980s, the escalator was stationary. Today, the escalator is moving backward at a speed of 7 to 10% a year. Now pay attention to this distinction. It is critical. Most people measure inflation by the price of milk and gas, and by that metric, things look manageable. But wealthy people do not measure inflation by the cost of survival. They measure it by the cost of freedom. Freedom is priced in assets. It is priced in shares of the S&P 500, in acres of land, in prime real estate. And if you look at the price of those things, inflation isn't 3%. It is often 10, 15, or 20% per year. This is why the safe path is a trap. If you are saving cash to buy assets, the assets are appreciating faster than your ability to save. You are chasing a finish line that is moving away from you faster than you can run. The doctor earning $300,000 a year who keeps their money in cash is actually losing ground relative to the asset owner who does nothing but hold a portfolio. The mechanism driving this is simple. Money enters the economy at the top. When central banks create liquidity, it flows first to banks, corporations, and financial markets. The people closest to the money printer, the investors and asset owners, see their net worth rise immediately. By the time that money trickles down to you in the form of wages, prices have already risen. The asset owners got richer. The wage earners got inflation. This is why the gap between the rich and the middle class is accelerating. It is not because the system is broken, it is because the system is working exactly as it is currently designed. In this environment, labor is a depreciating currency. Your time and effort are being devalued every single year. The old advice told you that your labor was your greatest asset. It told you that if you just worked hard enough, you could out-earn your problems. But in a world of asset inflation, you cannot outwork the printing press. You can be the most productive employee in your company, but if the currency you are paid in is losing value at a rate of 10% a year against the assets you want to buy, you are mathematically stagnant. This is the aha moment that shifts everything. The game is no longer about how much income you can generate, it is about how fast you can convert that income into something that cannot be printed. Your parents didn't have to worry about this. They could be passive. Today, passivity is poverty. If you leave your money idle, it dies. So, where does this leave us? It means we have to stop viewing our parents' advice as a moral compass and start viewing it as a strategy for a deprecated game. You cannot win a game of chess using the rules of checkers. To escape, you need to fundamentally change your relationship with money. You need to stop thinking like a laborer who protects their wages and start thinking like a capitalist who leverages their assets. You need to understand that in the new system, debt is not always a sin. Sometimes it is a tool. You need to understand that saving is not a virtue. It is often a vice. And most importantly, you need to realize that the goal is not to have more money. The goal is to have more ownership. Because in a world where money is infinite, the only thing that matters is owning the things that are finite. The old script taught you to chase the infinite, more dollars, higher salary. The new reality demands you chase the finite, equity, land, resources. Now that we've dismantled the old map, we need to draw a new one. We need to look at the hierarchy of wealth in the 21st century. To visualize this, imagine a pyramid. For most people, the base is labor. They trade time for money. Above that, savings. And at the top, maybe some investments. This is the labor-first model. And as we've established, it is structurally flawed. The new playbook flips this pyramid upside down. In the modern wealth hierarchy, the base is not labor. The base is assets. The wealthy do not focus on maximizing their salary. They focus on maximizing their equity. They understand a simple truth that escapes most high earners. You cannot work your way to freedom. You have to own your way there. When you own a piece of a business, a portfolio of stocks, or a rental property, you have detached your financial survival from your physical presence. You have moved from a linear income model to an exponential model. Your capital works 24 hours a day, 7 days a week. This shift from earner to owner is the first step, but it leads us to the second tier, which is the most controversial. The second tier is leverage. The old advice taught you that debt is a sin, and if we are talking about credit cards used to buy clothes, that advice is still correct. That is bad debt. But in the new economy, there is such a thing as constructive debt. Wealthy people use debt differently than poor people. Poor people use debt to buy liabilities. Wealthy people use debt to control assets that pay for the debt itself. Think about the mortgage on a rental property. If you borrow money at 6% to buy an asset that appreciates at 10% and the tenant pays the interest, that debt is not a shackle. It is an accelerant. It allows you to control a large asset with a small amount of your own money. But here is the deeper nuance. When you take on long-term, fixed-rate debt in an inflationary environment, you are effectively shorting the currency. You are borrowing dollars that are worth a lot today and paying them back over 30 years with dollars that will be worth significantly less. In real terms, inflation pays off your debt for you. If inflation is running at 7% and your interest rate is 6%, the bank is technically paying you to borrow their money. This is why the obsession with paying off the mortgage can be a mathematical error. By rushing to pay off cheap debt, you are trapping your liquidity in the walls of your house where it earns 0% instead of deploying it into assets that compound. The third tier of the new hierarchy is tax efficiency. This is the silent killer of the labor-first model. If you rely on a high salary, you are in the highest taxed bracket. The government takes nearly half of what you produce before it ever hits your bank account. You are working from January to June just to pay the state. The new playbook recognizes that the tax code is written to incentivize investors. Capital gains taxes are lower than income taxes. Depreciation on real estate can offset income. Borrowing against assets is not a taxable event. This is why billionaires pay lower effective tax rates than their secretaries. It isn't because they are cheating, it's because they are playing by the rules of capital, while the secretary is playing by the rules of labor. So, how do you actually apply this? You don't need to quit your job tomorrow, you just need to change your order of operations. The old script says, earn, spend, save what's left. The new script says, earn, invest, spend what's left. You need to treat your investment contributions like a tax, a mandatory bill that must be paid before you pay for your lifestyle. You must aggressively convert your depreciating cash into appreciating assets every single month. You stop measuring your success by the balance in your savings account and you start measuring it by your net worth. When you make this shift, your psychology changes. You stop looking at a luxury car and seeing a monthly payment you can afford. You start seeing the opportunity cost of the capital that could have been buying your freedom. You realize that every dollar you spend on a liability is a soldier you just fired from your army, and every dollar you deploy into an asset is an employee that will work for you forever. But there is a catch. Transitioning to this model requires you to navigate a period of intense discomfort. You have to be willing to look broke in the short term to be wealthy in the long term. You have to delay gratification in a world that is screaming at you to consume. And this leads us to the final hurdle. It's not mathematical, it's emotional. The hardest part of this transition isn't the math, it's the guilt. When you start investing aggressively instead of paying off the mortgage, or when you buy volatile assets instead of hoarding safe cash, it feels like you are betraying the people who raised you. It feels reckless. But you have to distinguish between their values and their tactics. Your parents valued safety, security, and freedom. You value the exact same things. But because the economic terrain has shifted, the tactics required to achieve those values have inverted. To honor their wish for you to be safe, you must ignore their advice on how to get there. In the 20th century, safety was found in a job and a savings account. In the 21st century, safety is found in ownership and equity. Remember what I said at the start about the most dangerous advice coming from those who love you? Now you know why. They gave you a map for a world that no longer exists. The game has shifted from income to assets. You cannot out-earn a system that is designed to devalue your currency. You can only out-own it. The moment you stop working for money and start making your money work for you is the moment you step off the treadmill. The choice is yours. You can continue to play a game that ended in 2008, or you can accept the discomfort of the new reality and build a portfolio that protects you from it. Real wealth is not about having a high income. It is about having the autonomy to wake up every morning and know that your survival is not dependent on someone else's payroll. If this conversation gave you a new lens to view your money, subscribe. No hype here, just clarity. I'll see you in the next one.